Hello students, today in this lecture 7, we are going to cover the following topics. First one is elements of credit risk. We will see what are the different factors that affect the credit ratings and the credit scores. These factors are usually termed as elements of credit risk. The next topic that we are going to cover is default risk, meaning of default risk. What are the different factors that influence default risk? Next, what is default probabilities that we'll see and how this default probabilities can be measured. Next topic is loss given default. This is a technical term that we usually use as LGD, that is loss given default. What does this mean? We'll see and how it can be measured. Next topic is loan portfolios. What do we mean by the term loan portfolios? Last but not the least, expected losses. What do we mean by the word expected losses and unexpected losses? Now let's start. Different elements of credit risk. The different elements of credit risk, as I have already told that these are actually elements, means they are the factors that affect the credit rating and the credit score. The first factor we can say is the payment history. It's very important. Payment history means what is the history about the payment of an organization, whether the company has managed to pay its due payments on time or it has some default, that is payment history. This factor often has the greatest impact on many credit scores, and this information can positively affect the credit score of a company. Positively affect if the history of paying all the bills of the organization on time all the time, if there is a history of this will affect the credit score positively, whereas we can say that if there is a late or missed payments, this will negatively affect the credit score. The next factor is credit utilization rate. What is this? This is the total amount of credit that an organization um, have availed based on the credit card limits compared to the amount of credit that it is actually using, which is also common credit score factor. It is also termed as common credit score factor. Now, a low credit utilization ratio, it actually indicates that the ability of the organization to manage the credit is good, and many lenders they like to see ratios of 30% or less. So lesser the credit utilization ratio, more it is good for an organization. Higher, it is not very good. Next factor is number of accounts. So number of accounts is how many credit accounts that an organization is having. It is also a very popular credit scoring factor. We can say credit scoring models, they also consider that how many accounts have balances, right? If you are having a credit account with a balance, so generally it's better to have more zero balance accounts. If you are having a credit account with a balance, that means that payment is pending. You have not made that payment on time. So if it is zero, then it is good. That means all the payments are made on time rather than that which is carrying a balance. Next factor you will see that the history of credit use. History of credit use means because past behaviors and experience that can help predict future behavior. So many credit scoring models they look back and consider how long you have used credit, including your oldest one as well as the newest account. They will also consider the average age of all the open accounts. What is the average age, right? So in general, it's better to have a longer credit history than a short one. Our next factor is credit mix. What is credit mix? The variety of types of credit that an organization is using. This is also a very good credit score factor in many models, you can say. Scoring models look at many credit cards and installment loans that an organization have, or if all the credit is the same kind, for example, if all the credit happens to be retail cards, etc. So this also gives have an influence on the credit score about the credit mix. Next factor is hard inquiries. What is hard inquiries? Whenever you request credit, the lender asks to look at your credit, which generates the notion of a hard inquiry on your credit report. Hard inquiry is like too many hard inquiries. This could indicate greater credit risk. However, most credit scoring models, they understand that you might be comparison shopping for a for a loan, and will generally treat multiple inquiries of the same kind as a single inquiry as long as they occur very close together. So definitely the impact of hard inquiries diminishes the older the inquiries get. This is the thing, but hard inquiries is actually not a very good indicator. It's a negative indicator. Hard inquiries are actually carried out when the lender have any doubt on the credit worthiness of the borrower. Next factor is negative information. Credit reports, they can contain negative financial information such as collection accounts, bankruptcies, charge-offs, and settled accounts. So this type of negative information can adversely affect credit scores in different ways and for different periods of time, depending on the severity of the information. So it is a very important factor. Next, we will have a look on the next topic, that is default risk. Default risk, we can say, it is the chance that companies or individuals will be unable to make the required payments on their debt obligations. This we have already seen when we were starting the credit risk and default risk. So another name of credit risk, default risk, we can say. Default risk is actually a subset of credit risk. When the company or individual, they don't make any kind of payment, unable to meet proper funding within specific time frame. Now, in order to mitigate the impact of default risk, lenders often they charge rates of return that correspond to the debtor's level of default risk. A higher level of risk leads to a higher required return. So obviously, if the default risk is more, then a higher required return is required. Default risk can change as a result of broader economic changes or changes in a company's financial situation. Economic recession can impact the revenues and earnings of many companies. Many companies, they influencing their ability to make interest payments on debt and ultimately repay the debt itself. Companies may face factors such as, we can say, that increased competition is there and lower pricing power, resulting in a similar financial impact. Now, entities need to generate sufficient net income and cash flow to mitigate default risk. This is actually needed. Sufficient net income and cash flow is not there, then default risk, the chances of occurring a default risk is more. Now, measuring default probabilities. First of all, we'll see that what is default probability. Default probability is the likelihood that over a specified period, usually 1 year, we say that a borrower of a loan will not be able to make scheduled repayments. So, chances of default is actually a default probability. Default probability or probability of default, it is written as PD. This depends not only on the borrower's characteristics but also on the economic environment, because sometimes the borrower's characteristics is fine. It is having sufficient cash flow, sufficient revenue for the time being, but something may happen in the external economic environment that will compel the borrower to change his behavior. Like something happens which will stop the complete revenue of this, or will reduce the revenue, uh, reduce the cash flow of the borrower, etc. So it depends on two factors. Firstly, its characteristics, what is the present condition, as well as what is the economic condition, future economic condition that may have any kind of bad impact on the borrower's characteristics. Now we will have some look at the different factors that influencing the default probabilities. What are the different factors? First factor is inadequate cash flow to service debt. Then declining revenues, higher leverage, borrowing more and more, higher leverage means that. Declining liquidity, the cash that was there in hand, it's going on decreasing day by day. Inability to successfully implement a business plan. So this is last one is very important. Suppose the organization started a business plan of their own and they're not able to successfully implement that plan. So all these factors will ultimately lead to increase the likelihood of this. Now borrower's willingness to repay also. Apart from all these factors, if they are positive, but still the borrower's willingness is a very important factor. If the revenue is not declining, liquidity is not declining, leverage is small also, low, it's not very high, but also it is successfully able to implement a business plan, all these are positive. But one last factor which is very important is that the borrower itself is not willing to repay the loan. So this is a very important factor. Now, loss given default. What do you mean by loss given default? Loss given default means it is the amount of money a bank or other financial institution loses when a borrower defaults on a loan. In most cases, this LGD, it is written in a short form like LGD. The most frequently used method to calculate this loss actually compares the actual total losses to the total amount of potential exposure sustained at the time that a loan goes into default. In most cases, LGD is determined after a review of a bank's entire portfolio using cumulative losses and exposure for the calculation. This is how we get this. So in a later lecture or another lecture that the link I will share on the comment box, you will see that the detail on this loss given probability, how to calculate this with some practical examples, I will explain in another video. I will definitely share the link in the comment box, and by clicking on that you can get a detailed calculations and all. Now, loan portfolios. What do you mean by the term loan portfolios? It is the total of all the loan accounts that is held by a bank or finance company on any given day and are being held for repayment. So all the collection portfolio is actually defined as the collection of anything. Now here, if you are talking about loan portfolio, you can say that it is the collection of all the loan accounts that are held by a bank or a finance company. These are the major asset of banks and other lending institutes, because these portfolios will fetch a amount of interest to the bank or finance company. So this is you can say a major portion of the asset of any bank. Now the value of a loan portfolio, it depends not only on the interest rates earned on the loans but also on the quality or likelihood that the interest and principal will be paid, right? The interest is earned is fine, but if there is some amount of credit risk is there which is associated with it, then obviously the chances of earning those interest rate will go down. So definitely the value ultimately depends on the quality or the chances that the interest and the principal will be paid. Now we move on to the last topic, that is the expected losses. What do you mean by this? Expected loss is the sum of the values of all possible losses, that is multiplied by the probability of that loss occurring. So what is the amount of loss which is multiplied by the probability of the loss? Like expected gain and expected loss, same thing. We multiply this, the probability and the corresponding amount of loss, the chances of loss and the corresponding amount of loss get multiplied, and in different scenario we add all those multiplied factors together and sum it up to get a expected loss. So this also similarly in another video lecture, the link I will share below, there we will get somewhere like how to multiply and how to get a with the help of numerical problems we will see how to calculate the expected loss. This is expected loss is equal to value of a possible loss into probability of default, right? So in another term we can write value of a possible loss. This is actually a loss given default, LGD. This is technically termed as LGD into probability of default, that is PD. Now unexpected loss. If we are getting a quantification of expected loss, definitely we'll get some quantification for the unexpected losses as well. The unexpected loss is the average total loss over and above the mean loss. Whatever mean loss that is expected, if something is occurring beyond that limit, that is unexpected, which the investor or the organization, business, they have not expected that. They made an expectation about this limit, and if more loss is occurring above that limit, that amount of loss is termed as the unexpected loss. It is calculated as the standard deviation from the mean. So if you are getting a mean, suppose it varies from this to this, it can be less also, it can be more also. If it is less, then that will give you an unexpected loss that is lesser than that, right? So at a certain confidence level, we get this standard deviation at a certain confidence level. That is confidence level, if we are saying that 95%, the mean is suppose mean means expected loss is suppose 1 lakh, right? So we are 95% confident, then the expected loss is 1 lakh, will be 1 lakh. Now suppose we say that there is a loss of about 2 lakh. So 1 lakh is more than the expected loss, right? We are 95% sure that we are going to have a loss of about 1 lakh, but the actual loss that occurred is 2 lakh. So 1 lakh is more than the expected one. So 1 lakh is the unexpected loss that occurred. You can see, right? So expected loss here is 1 lakh, and unexpected loss that occurred suddenly without any expectation, that was more 1 lakh. So total loss is 1 lakh plus 1 lakh. So we can say that total loss at any point of time is equal to the expected loss plus the unexpected loss. That will give the total loss. This is actually also referred as credit VAR, value at risk. We have already covered what we mean by value at risk in our previous lectures. So if we are considering about the credit risk, it is termed as credit value at risk, that is credit VAR. So here we wind up our session of today. In the next lecture, we are going to cover credit derivatives. What do you mean by credit derivatives? Different types of credit derivatives. These are types of credit derivatives, that is credit default swap, CDS, credit linked notes, CLN, and collateralized debt obligation, that is CDO. We'll see what are these and different types of workings. All of them work in a very different way. So that we'll see. And credit derivatives, what is it? That also we'll see in our next lecture. So thanks all the viewers for bearing with us, and I hope that this session was useful for all of you. So here I end, and thanks to all of you. Stay safe and stay healthy. Thank you.